Welcome back, guys, to the roundtable. My name is Adam. With me today, Rusmin, Victor.
Hi, everyone.
Thank you so much for joining us once again at this roundtable. And today we're going to talk about how low do you go before you sell a stock. So how low do you go, guys?
When it's low enough.
Low enough.
It depends on you,
It really depends. So we're going to explore this topic at this roundtable. So I think Warren Buffett has a very famous quote where he says, rule number one, don't lose money in the stock market.
Yeah.
And rule number two,
never forget rule
number one. So I think we want to share a mathematical reason why you really don't want to lose money in the stock market or lose a lot of money anyway. Okay, there are times where you have to lose some money because you can't be perfect in your investments.
Yeah.
But just play a game, and you can play a game along with us, behind the screen, and we're doing this very simple game. So the game is when you make a 10% loss, how much do you need to gain back in percentage to break even, to go back to zero?
11%.
11%. All right.
Yeah.
So as I'm asking you the question, you can just do a quick calculation and just think how much you need to gain to break even again. If you lose 20%, you gain 25%.
Yeah.
If it goes down to 30%, you got to gain 43% just to break even again. So I think it just goes to show that it's not as simple as just going down and coming back up. It's just as easy.
Yeah.
Because sometimes when a stock goes down, there's a reason why it goes down that much.
Yeah.
And whether it can actually go back is a huge question mark. So we're going to talk about this today. All right. So if you didn't know about that, that's why you really don't want to lose a lot of money in the stock market. Okay. So to get back to where, square one is going to be a lot of emotion as well. So we're going to deal with emotions right now. How do you deal with emotions when you lose money? How do you feel?
Of course, when you buy a stock and the price goes down, sometimes it can be quite scary. In fact, I have this old man, I think he emailed me about 4 years ago with the title, "Please help." Right, so I thought what happened, right? And basically, when I read his email, and he actually invested in a bulk of REITs in Singapore, and I think a couple of weeks later, the prices of the REITs that he bought started to drop, and then he started to panic, and he didn't know what to do, and he started to cash out all his position. And then he told me that he was lost at that point in time, right? And those money that he invested is basically all his saving, his retirement fund, right? And he kind of panicked, he don't know what to do, and he got stuck, right? And this is what happened when you just listen to stock tips, right? You have no idea what companies you're buying, or you just simply listen to some people talking about certain stock and you just buy. And the next moment when the price drop, you don't know what to do, right? So the first thing that you need to do, of course, is to understand the company, the reason why you buy into those company, because you can't borrow a conviction from someone else, right? You need to build a conviction from yourself by doing the research.
So then you're sure about it. Even for us, even if you're listening to what we share, our opinions and all that, at the end of the day, you need to do your own due diligence so that, like Rusman, you're saying, you have conviction in your own analysis.
Yes.
You trust what you're, observing, and then you can hold on to a stock if it goes down.
Yes.
Yep.
Yeah. So
I think you must. We all must understand that actually the stock market is a very volatile place, right?
Yeah.
Going up 10% or down 20% or maybe down 10% is rather common. It's very common. It's part and parcel of the stock market, especially when there's a lot of mini crises happening once in every 3 years and also. So able to stomach losses for a temporary time and wait for a recover is like what Rusmin said. You need to have very have faith in your conviction, right? You also must have faith that the stock market will always go up, right? If your faith about the market is like very gloomy, stock market is going to end and all this, then eventually I think no matter what percent drop, you will just be afraid. Man.
You're probably better off not investing and putting something, just put it in a bank and just that's it.
As much as you want to be careful in the market, but there's have to be some optimistic in terms of on a longer horizon. You think that the market will always go up.
Yeah,
right?
Either in the overall market, which tends to happen, or in the investments that you pick because you did your research and you believe that in 5 years' time, this company is just going to be more successful than it is right now. It's going to be worth more. Yeah. So you need to keep that long-term perspective. But that, again, all boils down to your due diligence and you believe in what you've done your research on. I think
once you've done your research, that's not the end, because once you put your money in, that's where the amount will start to fluctuate up and down, right? So volatility is not risk. A lot of people actually confuse volatility as risk. When the price goes up, you make money, brilliant, right? When it goes down, you're like stupid. Right? You can't make the decision. You can't keep on judging the performance of your stock, right? based on your skill, right? I mean, for us as investors, a long-term investor, you need to focus on the process, right? Process is what will eventually lead to the good outcome. So if you focus on improving the process along the way, I mean, we all make mistakes along the way, but it's important to make sure you strengthen the process over time, right? And this is something that all of us have our own investment process and how you do your research and all that to build a conviction. That's something that is actually truly important rather than just focusing on day-to-day fluctuation. So volatility is not really risk. In fact, it's a friend for us, right? So when we found a good company to put in a watch list, and when the volatility start to comes in, the price drop, we actually use it as an opportunity to take a position on that, right? So, and of course, sometimes you talk about all these logical principles that you need to follow, but as a human, we are all very emotional, right? I mean, it's something that I can't just teach you. You have to go through yourself, the experience. Especially if you put in a lot of money, you get more emotional when the prices drop, right? And the best way to deal with being too emotional when you invest in the stock market is, of course, invest the money that you can afford to lose. Right, because there is the emotion connection that you have with your money, especially if the money that you put aside and you wanted to have that money for your marriage or maybe buy a first home or your children education, right? Or something that you plan that you're going to need it in the next 3 years. Okay, and if that's the case, I think you should not even invest your money in the first place. Because anything happens to the money, and especially when you put in the stock market, it starts to fluctuate, you'll panic, right? And just like the old man that emailed me, because those money is his entire retirement. He's quite old, I think in the late 60s, he's got medical condition. And I think, the moment the next 3 days, the prices go up, he was very happy, right? And next moment, when his price started to collapse because interest is going to go up, a lot of REITs that he invested started to come down. He panicked, he don't know what to do, and he cashed out everything because he couldn't see the amount actually drop. Right? He's
he just couldn't bear that. That amount.
He has a very strong attachment with that money, and the best way to get rid of it is, of course, start from amount that you are comfortable with, that you can actually lose. You can afford to lose, right? But the whole idea is not like you want to throw away your money in the stock market, right? You want to have the mindset that anything happens to this money, it will not affect your emotion. Because the worst thing or the most common mistake that people make is that when they invest, they usually buy high and then sell low. And why they sell low? Because there's a lot of bad news, panic, kind of situation where people will just sell because the market is going to crash, etc. Right?
So I think it's rather common is when the share price drop by 20%. The first thing that comes in your thoughts is my thesis wrong? Did I make the wrong decision?
You start to doubt yourself.
My take is that, I mean, as a new investor, I think this is rather common. I mean, I also feel that way when I started investing initially, but it really takes you, many years to detox. Going through the stock market, detoxing your emotion, and finally you're able to stomach the 20% loss, right? And when the 20% loss happen, the first thing you need to do is go back to your thesis and say that, is there any change to your thesis? If there's no change to your thesis and the stock still fundamentally strong, then I think that's not an issue holding stomach the 20% loss. But if in the event where you say that the stock dropped 20% because there's a fundamental change in the thesis that you initially analyze, then I think that's the time where you should, take a look at your investment. Maybe you should cut some losses over there.
So I think I should kind of like step in right now, because I think that's a pretty good question that I think a lot of viewers would have. I mean, yes, stock prices go up, they go down. You have an emotional reaction to that. And one little game that you can play with yourself is you can do a little mind experiment and think about, close your eyes and think, if I own a stock and it drops 10%, how do I feel? And most people will go like, yeah, sure, 10%. Whatever, right?
But when it happens,
but close your eyes and think, what if it goes down to 20 or 30%? And you might get a very different reaction from inside. And you start to realize that is your risk tolerance to certain things. And that's what you're gonna have to do that for yourself. Everyone is different. But I think the question that a lot of people would have is that, yes, stocks will go up and go down. Some of them will go down. And the question at that point is, what do you do? How do you know, like you were saying? How do you know that it's just a temporary thing and maybe the fundamentals are still intact? Or maybe it's a permanent shift in the structural trends and everything, and it's time to get out. So how low do you go before you actually sell? I think that's what we're going to discuss at this point in the roundtable, is that how do you know when to sell and when you should hold? I think that's a question a lot of people have. So I think let's go back to the one that you were talking about, was basically the fundamentals and you change your fundamentals if your thesis is still correct. So how do you know when to sell, when to hold in that case?
Okay, so for instance, the number one factors that I look at. If there's a structural change in the business, I'll definitely sell the company. Okay, so let me give you an example. For instance, let's say you owned Singapore Press Holding, basically the national newspaper in Singapore, right? And their main revenue generated is from the newspaper advertising. And advertising have, been really structurally changed already. Right? People do not advertise on the newspaper, they advertise on the Facebook, your Google, and other social media platforms, right? So this is a fundamental change, even though that majority of the revenue is contributed from advertising for SPH. So you know that moving down the road, let's say the next 5 years or 10 years, they're going to be a hard time for this company, right? And they have to shift the business. And the probability of earnings decreasing is very, very high, right? So this is the part where I would say that, okay, I have to sell this business if I ever own Singapore Press Holding, right? So that is an example of a structural change.
So you kind of have to know, which is why you have to go back to your research. Because if you don't do any research, you don't know what's happening. But in this case, SPH, I mean, now they no longer own the media business. It's been hived off. But yeah, if that's a great example, because if you kind of can tell that everyone's advertising digitally on Google and Facebook, there's no way it can go back to the old days. So that's kind of like a permanent shift.
Correct. So the main question you need to ask yourself is, the business that are invested in, right, are they being disrupted? If they are being disrupted, then probably that's really a structural change to the business. So moving 5 years down the road, they may not see a brighter future, much a gloomy one.
So I think the first step is that structural change is probably a permanent one. Probably want to get out if it's going to
not the share price fluctuation.
Nothing to do. I mean, share price is because of these things that are happening, but not the share price itself that causes you to sell. So I think the first one is basically structural change. All right. So any other things that you decide? Whether to buy or sell. I mean, to sell or hold.
When you realize that you made a mistake in your analysis. Right? So when you realize it early, you better cut early. Right? Sometimes you can be in the gain position, you may cut as early as possible. So this is what happened to me, even for Victor. When we actually invested in the dry bulk shipping industry, that was, I think, almost 10 years ago. Right? So this is an industry that I think we thought that it would turn around. We did a deep dive analysis on the industry. We thought that we know, right? But then it is an industry that has been, the most difficult industry to be in as an investor, right? And we only realized it, I think, 5 years later, which by then the losses will be amounted to even bigger, right? So today, of course, on the high side, when you look back, and this was a clear case where we should have sold it, right? It was sometimes, when you invested in the company and it tends to consume news that, bias.
The confirmation bias,
right?
News that kind of agrees with your position.
Yes. Yeah. So, and then along the way, you realize that your losses as you go up to 40%, 50%. Of course, 2-3 years down the road, you need to review your position. You need to be neutral, and then revisit the idea. Sometimes you could be blinded. You just didn't realize it. It's something that you made a mistake.
I think you minimally have to revisit your TCs every once a year. That's the bare minimum, right? Of course, best is every half a year. If it's a much smaller company, I think every half a year you should review it.
Okay. Yeah. So in that case, I remember that dry bulk. You guys did a lot of research. It wasn't like you guys jumped in blind or anything. You guys did a lot of research on that industry, and at the end of the day, it was a mistake.
There are too many moving parts in this industry, right? So it's very difficult to get it right. It's very difficult to time the cycle. So that's something that we have to learn to accept that fact. And then we just move on from there.
So it's just like put aside your ego and go like, made a mistake, cut. So I think that's one of the things that reasons when you should sell. So you made a mistake. I think you should just move on.
Correct. Right. That's right.
I think any other I think this is one good example. Basically, the fundamentals in the company and all that. Maybe it was a structural thing as well, the whole industry. But what happens if this was a mistake in analysis. You got it wrong. All right, you're gonna move on. But what if you bought a company and it's doing well, but then suddenly it doesn't do so well? How do you know that the fundamentals have shifted? How do you know it's a temporary thing or is it a permanent thing that I should get out of this? How do you make a difference? How do you tell?
Sometimes there's a very fine line to, when it comes to detecting such companies. So maybe let me give you an example of First REIT. This is one of the companies, REITs that I think used to be very popular among all the income investor, right? So he was giving a yield about 8 to 9% at one point. I think that was in 2019, and it was a stock REITs that a lot of people have been asking us, whether they can invest in them, right?
So First REIT is actually a medical hospital company in Indonesia, right?
So it's
in Singapore.
Yeah, it's basically a REIT that own all the hospital in Indonesia, and it's sponsored by Lipo. So I mean, the hospital is supposed to pay in rupiah, but they actually pay First REITs in Sing dollar, right? So that rupiah was actually borne by the sponsor, and then sponsor subsequently paid the REITs in Sing dollar. So there was an arrangement, right, when they went IPO. But over time, as the currency of rupiah depreciated against Sing dollar, I think that has actually gotten worse over time. And, there was the shift in terms of big structural change, right? So far, you look at the past 5 years dividends, at a point of time when a lot of people was talking about it, 2015 and 2019, the dividend was about 8.3 cents, has grown to about 8.6 cents. It looks like a very stable kind of dividend stock. But, as you know that, we have a lot of people asking us, okay, so when we went to analyze that REITs, we actually realized that the rupiah has depreciated so much, and I went to, dig out more information that the Siloam Hospital, which is listed in Indonesia, was actually paying a rent about equivalent of Sing dollar about 20 million, and First REITs were actually receiving about 90 million or 90 million in rental. So that 17 million of gap is actually borne by the sponsor. So it is not sustainable. So when the leases is going to renew in the next few years down the road, which is I think pretty much this year, the rental will fall, right? And so subsequently they have restructured the rent, and today they are actually packed based on rupiah.
So to give a perspective, right, the agreement that they make is based on 1 Sing dollar to 5,600 rupiah. Okay, the rupiah actually depreciate to 10,000, so they have to continue pay 1 to 5,600 until this year, right? Which they already restructured it, and they pay a lower rent, pay a lower dividend from here.
I think we covered First REIT in a previous roundtable. I think we're comparing it to Parkway Live REIT. So if you want to know more about that, you can go check that out.
So if you're an investor at First REIT, and then when you realize it's not a fundamental crack, you can sell along the way. Even though you're having losses, you can sell it. You don't want to, a lot of time when it comes to selling, people always hope that you'll rebound, they'll at least break even, then they sell. No, that's the wrong mentality. As soon as you realize that there was a crack in the fundamental, you want to quickly sell it. You don't want to hold on to that, right? And there was a lot of mistake that a lot of people actually, when I talk to, they make the same common mistake.
But I think that the thing about is, right, when the rupiah depreciated, right, the investor got at least 1 or 2 years to sell before the market react,
Correct.
So you actually can find out this information inside their prospectus, and you know that, the rupiah depreciate, this is no longer a proper thing. Right, so they only start falling at I think 2018. The rupiah I think happens around 2016, 2017.
It's been over time, right? So and then today, if you look back, it's 20 over cents versus a year in 2019. So it's like it got worse over time. So the point here is that you don't want to hold on to your losses. A lot of time people like to keep their losses and then sell their winners. And the moment that the price of the stock that they bought goes up 30, 40 videos, and they quickly sell it, because if they say they don't sell it, how are they going to make money? So that's the common opinion, the point that I always got from people.
I think you should hold your winners and sell your losers.
I think we go back to the mathematical table that we put out. I mean, if it's going down for a reason, and for it to go back up, it's going to be quite tough. It's better to, I think, in this sense, if you think that this company fundamentally isn't as great as it once was anymore, you should just recycle that capital, put it in something else that's it's growing, in a much better company.
But I think you have to think on this perspective is that if, let's say, this company you already make 50% losses, right, and you know that there's a fundamental change in this company, and most people they will continue hold on to the 50% losses, hoping that it will go back up, back, right, to the break-even point. Even I know that most people, right, when it go back to the break-even point, no one will sell it, right?
They will want to say, okay,
it's doubled up, so maybe you could double up again.
So the perspective is to really think in this way. So if I were to hold on to this 50% loss in the next for the next 10 years, most probably it will still remain that losses, right? But if I were to absorb this 50% loss, right? Let's say from 20,000 I left 10,000. I took this 10,000, invest in one company that compound for the next 10 years. Let's say 15%. That will be I think around 4 times return in 10 years. You can easily cover back your losses.
So it's the opportunity cost, right?
Yeah, correct. Because the thing about investing is not about the money. It's about the time, right? Money you can earn back anytime, right? But the time, when you lost the time, you will never get it back, right?
Unless we get to live forever, but we
you can't live forever.
80 years old, you're gone, so you got to make most use of your time. I think that's a great point, is that you have to think about investing in terms of time. I mean, the returns are important, but it's always against the clock. You're running against the clock, right?
We all have limited time.
Yeah.
Right.
All right.
So that I think of course the other option when it comes to selling is when you found a better opportunities for the companies that you invested. Let's say you are in the property industry, which happens to me, and we used to invest in a company that has a lot of development, and then subsequently we saw a company that have derived about their revenue comes from recurring rental income, and both are trading at the same valuation. One is giving a better yield, the investment property companies are giving better investment yield, and both are equally attractive. Which one would you invest? Obviously you go for those that are lower in terms of risk, right? And the valuation also come very attractive. Right? So when you find better opportunities in the same industry, almost the same quality, right? Of course,
it's growing much faster.
It's growing much faster. You will want to switch over. Yeah, even though you could be sitting on the gains or losses, you just want to switch over because that is a better investment.
So it's about optimizing your portfolio because you I mean, there's only a number of stocks that you want to have in your portfolio.
Correct.
Right?
Yeah.
You don't want to go to 50, 100 stocks because you can't monitor everything.
But again, it's all you're against time again. Right. So if you got one that is growing slower than the other one is growing faster, of course you want to switch over to the one that's growing faster.
All right. But in this case, of course, your initial investment could be making money and you just switch it out. But sometimes, of course, it's a loss. You can just decide, I got a better investment. I just want to move. All right. So I think this is a pretty good... I mean, we've listed quite a few factors over here. Basically, there's a structural change in fundamentals within the company.
You make a mistake
in your investment thesis. You got to get out, and then of course, find a better opportunity. So these are the reasons when we would decide to sell a stock. So how low you go, it really depends. It's not actually that's not the question actually, because it can go down 10, 20%, 30%, but if everything is intact, you hold on to it. Because I remember to give a counter example, I remember Facebook, right? Back then, the Cambridge Analytica scandal, I think Facebook dropped about 30%. 20 or 30%, thereabouts. But the fundamentals were still intact. Everyone I knew was still on Facebook or Instagram. Is still making money through advertising. So, I mean, look at Facebook right now. It's about, I think, $350, $60. So it's gone back up again. So, I mean, along the way, there was some other rides along the way as well. But I think this is the point that, if you understand your business and the fundamentals behind it, even if it goes down and it's a temporary thing, you hold on to it.
And I think to put it in today's context, the most relevant example is going to be Alibaba, right? So today I'm actually down about 20%. So am I supposed to panic? Which, I mean, if you're not someone who doesn't know about Alibaba, what they do and all that, of course you'll be panicking. You look at the price, it's down 20%, you put a lot of money there, of course you're going to lose a lot of money. You'll be panicking, right? But we know a lot about Alibaba, right? And in that case, we don't panic. In fact, we look at the fundamentals of the business, whether people are still spending on the platform. And that's something that we track. You need to keep on monitoring because things may change along the way. But so far, I think it's been quite healthy.
And at the same time, of course, you still do your diversification. You don't put all your eggs in one basket.
Correct. All
right. So I think this is a pretty good, summary of I think what we discussed. That it's not about how low you can go. It's about what happens when it's low. So then that will decide whether you should sell or when you should hold on. So I think that's a pretty good summary of what we've discussed so far. So I hope that really kind of give you a few new distinctions if you didn't really know that. So I think that's a pretty good wrap up, guys. All right. So I think once again,
thank you.
You want to thank yourself because you give a lot of good information over there. So once again, thanks for watching. So my name is Adam Rusmin. Victor, thank you so much for joining us once again. I really hope that this roundtable was a really good one for you as well. So if you like our content, please hit the like button. Tell us we're doing a good job, and of course subscribe to our channel. Many more roundtables.
And share it with your friends.
Share with your friends. Especially if you know someone who's like super emotional when it comes to investing in the stock market. I think we all know someone like that. If you think this will help them, let them know as well. And of course, any questions, comments, put them in the comment section. We will have we'll answer your questions as well. So once again, thank you so much for being here, and we'll see you around again.